So, you want to buy a gym? Here's the number that should scare you before we even start. In 2024, one gym company refinanced $1.2 billion in debt with a fresh $1.8 billion from private equity. That's Equinox. A company that sells you a treadmill and a eucalyptus-scented towel is playing in the same capital markets as an airline. You probably think of a gym as a guy with a clipboard and a mop. The people actually buying into this industry think of it as a real estate portfolio wrapped around a recurring subscription. And they're not wrong. So no, this isn't a business about dumbbells. It's a business about real estate, recurring billing, and human willpower. And all three of those are more volatile than they look. Let's talk tiers, because a gym can mean four completely different businesses. Tier 1, the independent neighborhood gym. Think a single CrossFit box or a mom-and-pop weight room. These trade on the small business market for anywhere from $50,000 to $300,000, usually priced off equipment value and membership roles, not brand power. You'll find these changing hands quietly through local business brokers all over suburban America. Tier 2, the budget national franchise. Planet Fitness. Total initial investment, per its own franchise disclosure document, runs $1.5 million to $5.2 million a location. You're paying for a proven low-cost membership machine, $10 to $15 a month, classic cards, $25-ish black cards, across a system with over 2,600 locations and roughly 20.8 million members. Tier 3, the boutique studio franchise, your Orange Theories and F45s, typically several $100,000 to open, riding on a class-based, appointment-driven model instead of open-floor square footage. Smaller footprint, higher price point per member, and a business that lives or dies on instructor talent and class scheduling instead of raw machine count. Tier 4, the luxury lifestyle brand, Equinox. Over 100 clubs globally, backed by 6th Street, Silver Lake, Aries, HPS, and L. Catterton. This isn't a gym anymore. It's a real estate and brand licensing operation wearing gym clothes. Notice the pattern as you climb those tiers. You're not really buying more iron. You're buying a bigger claim on somebody's monthly habit in a better zip code with a longer lease attached to it. So how do you actually get in? Option 1. Buy new, straight from a franchisor like Planet Fitness. You sign the FDD, pay a $20,000 franchise fee, hand over 7% of gross membership revenue and royalties every month, and build out 15,000 to 30,000 square feet of leased retail space. Option 2. Buy an operating gym on the secondary market. Existing member base, existing lease, existing cash flow, priced by a broker off trailing revenue, no different in spirit from buying a laundromat or a car wash. Option 3. Buy distressed. When 24-Hour Fitness filed Chapter 11 in June 2020, it shed $1.2 billion in funded debt and closed more than 100 of its 445 clubs. Every one of those closed locations meant equipment, leases, and member lists hitting the market at a fraction of replacement cost, the exact moment a patient buyer wants to be standing there with cash. And the one recent transaction that tells you who's really circling this space, that $1.8 billion Equinox refinancing in March 2024, led by 6th Street and Silver Lake, with Goldman Sachs, Morgan Stanley, and J.P. Morgan supplying a new credit line on top. Why would a private equity fund want this? Because a gym membership is a monopoly on a person's guilt. Once you've signed a 12-month agreement and paid your initiation fee, canceling costs more emotional energy than just letting the draft hit your card every month. That's not a side effect of the business. That's the business. L. Catterton understood that math back when it first invested in Equinox in 2017. 6th Street and Silver Lake are betting on the same behavioral inertia again now, to the tune of $1.8 billion. So what does the money actually look like on the legitimate side? Stream 1. Membership dues. Planet Fitness alone pulled in $1.3 billion in system-wide revenue in 2025, up more than 12% year over year. That's Stream 1, and it's the boring one. Stream 2, tiered upgrades. The classic to black card upsell. Tanning, massage chairs, guest privileges, is where the real margin lives because the equipment's already paid for. Planet Fitness raised its entry-level Classic card from $10 to $15 a month in 2025 and still added 1.1 million net members. That's pricing power most retailers would kill for. Stream 3, personal training and add-on services, which at a luxury operator like Equinox can run into the hundreds of dollars per session, subsidizing a facility that would otherwise just be a very expensive room full of machines. Stream 4, at the high end, full-blown brand licensing, Equinox Hotels, SoulCycle, Blink Fitness, all sitting under the same holding company, each monetizing the same aspirational logo in a different room. Here's the non-obvious part. The membership itself barely needs to break even. The real money is in the psychology of the upsell, and in a member who keeps paying but never walks back through the door. Now the reality check, because the costs don't care whether you show up. Rent and build-out dominate everything. That $1.5 to $5.2 million Planet Fitness number is mostly leasehold improvements and equipment, not cash reserves sitting around for a bad year. Then there's staffing. Mostly minimum wage adjacent front desk and cleaning roles, deliberately thin, because the model can't absorb heavy payroll on top of rent this size. Layer on a 7% royalty and up to a 7% local advertising fee, both due to the franchisor whether or not the club is profitable that month. Then insurance, utilities, and equipment maintenance running around the clock every day, whether or not a single member walks in. And the costs don't pause for a crisis. When COVID hit in 2020, 24-Hour Fitness still owed rent, still owed vendors, still owed its 19,200 employees, while every single location sat dark. It took a $250 million emergency loan just to keep the surviving club's lights on through reopening. That's the exact chain of events that put the company into bankruptcy court that June. Multiply that across an entire industry, and you see why 2020 wasn't a bad year for gyms. It was an extinction event for anyone whose lease and payroll outran their cash on hand. Now the part nobody puts in the brochure, the shadow economy of gym membership. The entire budget gym model is built on a bet that most people who sign up won't show up. Operators plan floor space and equipment count assuming only a fraction of paying members ever walk through the door in a given month. The gym sells you access, banks the recurring $10 or $15, and quietly hopes you stay home on the couch. Oversell the capacity, undersell the attendance, and the math works beautifully. It's not a scandal, it's the business model, hiding in plain sight in the fine print of every dues draft agreement you signed on your phone at the front desk. The regulatory flashpoint here isn't hidden either. State attorneys general across the country have spent years fielding complaints and issuing crackdowns over how hard health clubs make it to actually cancel a membership once you've signed up. Cancellation by mail only, in-person only cancellation windows, the whole playbook designed to add friction at exactly the moment a member wants to stop paying. Now for when it goes wrong. 24-Hour Fitness, 445 clubs, $1.2 billion in debt wiped out, more than 100 locations gone forever. The lesson: a lease is a fixed cost, and a pandemic doesn't negotiate. Gold's Gym, filed for bankruptcy the same month, in May 2020, permanently shut 30 locations, and still emerged carrying its name into a leaner shell. The lesson: even a globally recognized brand is just a logo stapled to somebody else's real estate risk. Town Sports International, the owner of New York Sports Club and Lucille Roberts, laid off much of its 7,000-person workforce and simply stopped paying rent across roughly 200 clubs to survive 2020, warning regulators outright that it might follow the others into Chapter 11. The lesson: when the model breaks, the first thing to go isn't the treadmills. It's the obligations you thought were fixed. And right now, in 2026, there's a live version of this risk playing out, not a lockdown, but a molecule. GLP-1 drugs like Wegovy and Zepbound are reshaping what people expect from a gym membership entirely, pushing the industry to pivot hard towards strength training and muscle preservation instead of pure cardio. One estimate puts the upside for gyms, studios, and clubs at a 20% bump. nearly $6.8 billion. As GLP-1 users start showing up to protect the muscle mass the drugs burn through. Bet wrong on which way your members are shifting, and you're renovating a cardio floor nobody wants in 18 months. So let's do the final math. Small tier, your $150,000 independent studio. Modest annual revenue, thin margins after rent and a couple of trainers, and realistically, you're not getting rich. You're buying a lifestyle and a piece of local real estate optionality, not a cash machine. And most owners at this tier will privately tell you the studio net's close to zero most years. Mid-tier, your Planet Fitness franchise. $1.5 to $5.2 million in, against average gross club revenue near $1.9 million, and per the company's own Item 19 disclosures, franchisees average $215,000 to $270,000 a year in profit once the doors are open and the members are drafted. Real money, but a 3 to 5 year payback on a 7-figure bet. Large tier, your Equinox scale portfolio. Over 100 clubs, $1.8 billion in fresh capital behind it, backed by sovereign-adjacent private credit and equity, where the actual gym floor is almost incidental to the real estate and brand licensing engine running underneath it. Notice what's actually consistent across all 3 tiers. Nobody at any scale is really pricing in the treadmills. The small studio owner is buying optionality on a lease. The franchisee is buying a proven behavioral billing machine. The private equity fund is buying a real estate and brand play with a gym bolted on for cash flow. The size of the check changes. The thing you're actually purchasing doesn't. Here's the one line to leave with. It was never a gym. It's a recurring bet that human willpower will fail on schedule every single month forever.